let's talk a little bit about what's actually happening in the world, and I think that's important. Is you have a perspective, you want to cross-reference it with regard to what the data is actually telling you. From our point of view, the lift story has already begun. It didn't begin with GDP growth picking up, but it began with a rebalancing of what were the causes of weakness as we went through the second half of last year. The shocks that hit us early in 2011 really hurt consumer spending, but businesses didn't pick it up, and they therefore were slow in adjusting. However, in the last 6 months, consumer spending picked up as the drags did fade, particularly the drag from inflation. To some degree, the Japanese earthquake lifted auto sales. GDP didn't rise. It didn't rise because we got a significant adjustment on the part of producers. That was a story which reflected an inventory correction taking hold. What we're seeing now is that inventory correction is far enough advanced. Businesses have been somewhat surprised by what they've seen in the demand side, that actually industrial activity is picking up globally. The numbers on the actual industrial production side, which have moved up to about a 5% pace in the last 3 months, we believe is overstating trends because it incorporates the Thai flooding effect, which is fading from the scene. But our business surveys, our Global Purchasing Managers Index, has made a turn. That turn is now about 4 months old, and we believe that's pointing to a more modest but nonetheless broad-based improvement that's taking place in global industry. If we're right about this, this is a story which is going to be most pronounced in emerging markets. The U.S. has already started the lift, and that was the fourth quarter of last year. As we're watching the data, what we have been expecting is coming to pass, which is the non-China Asia economies, Japan, Korea, Taiwan, are beginning to take part in this lift, and we think the next stage and the most important stage is going to be whether China and Brazil, two big emerging market economies, take part. We would agree that housing is a significant drag on the Chinese economy. We would agree that policymakers are not trying significantly to offset that in terms of turning the tide on housing, but we think they are moving fairly aggressively here in terms of putting other infrastructure spending into place by easing monetary policy, allowing lending to increase at a more rapid pace, and providing fiscal initiatives for the consumer. From a base of growth, probably around 7% at the start of the year, we think these forces are going to start to kick in, and we think they're going to kick in with more power than most people expect. And we think, again, 3 to 6 months from now, we think the Chinese economy will be growing above a 9% pace. Looking at the data from a high-frequency point of view, I'd say there's some very important indicators that we pay a lot of attention to, which are actually telling us things may be moving faster. Our overall Purchasing Managers Index is telling us growth is running about a percentage point above our current forecast. In the U.S., the movement in jobless claims, the ISM survey, which is not presented on this panel, is moving in a way that's pointing to much more rapid growth than we've got in our forecast. But we are remaining cautious in terms of the speed at which this lift takes hold. Part of it has to do with the concerns about energy prices. And I'd want to emphasize our concerns are not about what's happened now. If you look at the movement in retail price of gasoline, some of that, we think, in the U.S. reflects seasonal factors, and you can compare on this panel that shows the U.S. retail price of gasoline how different the seasonally adjusted and non-seasonally adjusted series have moved. You can also see how modest the shock right now is in relation to what happened last year at this time. However, the concerns about geopolitics combining to push oil prices up higher, to affect confidence, to have a direct impact on financial markets as people worry about more broad issues related to stability, is, I think, the most significant risk to the outlook right now. The other concern we have, and what constrains us in terms of becoming more aggressive in our forecast, is the fiscal policy backdrop in the U.S. The U.S. household sector is more neutral today, but it remains depressed as it looks forward into the future about income gains. An important part of that has to do with the public sector drag on labor income, the fact that fiscal policy is tightening and moving transfer payments down, moving labor income down in what is 1/5 of where the U.S. labor market generates its jobs. And that's going to continue to be a drag, and perhaps most importantly, as we look out towards the end of this year, we have enormous amounts of fiscal policy stimulus that are expected to expire. The Bush tax cuts, the payroll tax cuts that have been recently extended, the unemployment benefit extension. We have spending cuts kicking in as a result of the supercommittee's failure to act. And on the back of all of these things, if nothing would change in legislation, we'd have a drag of somewhere on the order of 3% of GDP in the US, a number that, if you scale it to the historical past, is bigger than anything we've seen since we unwound defense spending after World War II. These are huge numbers, and nothing in this front is going to be dealt with until after the November election. So we have this big cloud hanging over our heads in a world in which I think the near-term cyclical lift is strong. What is going to happen as we turn into 2013? I can certainly give you some thoughts on that, but I think right now it's a big uncertainty in the political space. The other thing which I think I'd want to emphasize as a major uncertainty here is the euro area, where we talked a minute ago about the good steps that have been taken to deal with liquidity by the ECB, and I think that is important. But I think there is a growth deficit in Europe and a divergence in performance here that is going to be very significant in terms of not allowing countries on the periphery to achieve growth that's consistent with their debt objectives. And I know this panel has an enormous amount of numbers. If I could just put your attention to the column which has those red circles, those show you what would be the cumulative fiscal adjustment needed by countries if their growth rate stood about 200 basis points below interest rates in an environment in which they're trying to modestly lower debt over the next 5 to 10 years. And those adjustments are just huge, unsustainable ones, we believe. So if you don't believe Europe can grow in a meaningful way, I think you have to believe that Europe is going to have to combine its fiscal problems into one. And that, I think, becomes the key issue, and one which is fraught with uncertainty in forecasting, whether the combination of good faith effort on the part of countries like Italy and Spain can bring the region to some kind of a coordinated approach to dealing with the debt overhang over the next couple of years. How that happens is, again, one of the reasons why I think it's very hard to extrapolate. The last thing I just want to say is talk a little bit about inflation and central banks. I think slack does matter. I think there's a lot of slack in the developed economies. I think we're unwinding some import price pressures from last year. And I think as a result of that, we are not facing any significant imminent inflation pressure. That said, I think we are in a world in which the Fed is not going to do QE this year. I think the growth numbers, particularly the employment numbers, will be strong enough that it'll keep them on hold. But at the same time, I would kind of disagree a little bit with Bill. I think the idea that the Fed is going to be doing anything from the rate side anytime in the next 12 to 15 months is just very hard to see in an environment in which inflation is not a problem, an environment in which we're getting growth but still have quite a bit of underutilized resources, and an environment in which, at least out towards early next year, the fiscal policy environment is so uncertain that not only are they unlikely to change rates, I think they're unlikely to change their message about the very long for low policy that they've expressed. So with that, I think I'll end just to make sure I don't go over and leave some time here for us to have question and answers. Thank you.